everyone, welcome back to Corporate Decoder. Today, Lindsay Corporation, or LNN as it is traded, just filed an 8K report, and it looks like they are losing their chief financial officer, but there is a significant payoff involved. Quick note, this is not financial advice, just my take on public filings for educational purposes. While the news of a CFO leaving might sound alarming, the details of their exit package tell a more interesting story about how the company is managing this transition. So, what exactly is this filing all about? It is a current report, meaning the company is sharing some important news that investors need to know right away. The big news here is that Mr. Sam Hinrichsen, the Senior Vice President and Chief Financial Officer, is stepping down. His last day will be the 31st of August of this year, 2026. The company says he is leaving for personal reasons, and importantly, there were no disagreements or issues with his departure related to the company's operations or accounting. That's usually good to hear, as it avoids potential red flags that could signal deeper problems. Lindsay Corporation is already on the hunt for a replacement and is using a professional recruiting firm to help find a new chief financial officer. This shows they are taking the process seriously. The president and CEO, Randy Wood, expressed his thanks to Mr. Hinrichsen, wishing him well. This is pretty standard language in these types of announcements. Now, here is where it gets interesting. Mr. Hinrichsen is not just walking away, he has agreed to stick around for a bit until the end of 2026 to help with the transition. This is called a transition services agreement. This is not uncommon and can be very helpful for companies to ensure a smooth handover of critical financial responsibilities. For his work during this transition period, Mr. Hinrichsen will receive $100,000. This payment will be made as a single lump sum after his transition duties are complete. He will also get his regular annual bonus for the 2026 year, which is a nice incentive to ensure he stays engaged and works towards company goals, even as he prepares to leave. This is a significant part of his exit package. He will receive another $110,000 in cash. The company states this is to basically compensate him for the value of his stock awards that would have vested if he had stayed until the 1st of November of 2026. So, while he is leaving before those awards fully vest, they are essentially paying him out the equivalent value. This is often done to ensure a positive departure and prevent any lingering resentment or legal disputes over unvested compensation. Given the market cap is around $1.2 billion and the stock price fluctuates between $97 and $148, this bonus amount seems substantial for the specific role. The company will also cover his health insurance premiums under COBRA for 4 months following his departure, extending through the end of his transition period. This is a common benefit offered to departing executives. And finally, the company is waiving any right they might have had to get back a cash signing bonus he might have received earlier in his tenure. This is essentially a final favorable term for Mr. Hinrichsen. The full details of this transition agreement are filed as an exhibit, which is like an appendix to this report. The document itself is heavily referencing that exhibit for the specifics. This section just lists all the documents they are filing as part of this report. This confirms that the Detailed Transition Services Agreement is Exhibit 10.1. And here we have the part where the company officially signs off on the report. The company name. And signed by the CEO, Randy A. Wood. This just shows the report has been formally submitted and approved by company leadership. So what does this all mean? On the surface, it is a CFO leaving, but the way it is structured with a paid transition period, a payout for unvested equity, and other benefits suggests Lindsay Corporation wants to ensure a smooth and amicable departure. This kind of package is often used to retain the executive's expertise for a critical period and to avoid any negative fallout from their exit. Looking at Lindsay Corporation, they operate in the industrial sector, specifically farm and heavy construction machinery. They have a market cap of about $1.2 billion and employ over 1,200 people. The stock has been trading in the range of $97 to $148 over the last year. Recent news suggests they are pushing overseas irrigation and have seen some shifts in stock indexes, with one headline even mentioning things might get worse before they get better, alongside a rating downgrade. This departure of a key financial executive, while presented smoothly, could be seen in the context of these existing pressures. The financial details of the separation package point to a company that values experienced leadership and wants to manage transitions carefully. The cash payout for unvested equity, specifically $110,000, along with the $100,000 for transition services and the bonus, suggest a total compensation package of around $210,000 plus the bonus for his continued service. This is a significant amount for a few months of work, but it could be well worth it if it prevents disruption in financial reporting and investor confidence during a potentially sensitive time for the company, especially with those recent negative headlines and a downgrade. My biggest concern is how this change at the CFO level might impact the company's ability to navigate the challenges mentioned in recent news. like the rating downgrade and the sentiment that things could worsen. The transition package, while generous, is essentially a cost to manage the departure. What I'm actually looking for is how the new CFO will steer the company through these headwinds, and whether they can reverse the negative sentiment. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord linked below.